And good afternoon, everyone. I'm Dan Rogers, CEO for the Kelowna Chamber of Commerce. Our webinar on the federal budget beginning momentarily, so we allow everyone to come in. It's a pleasure to have you here. Yesterday in Kelowna, we called it Budget Day. We had the BC Finance Minister talking about the BC budget at the same time as the federal Finance Minister was tabling the budget in Ottawa, and that's our focus for this session. I do want to acknowledge before we get too deep into our seminar today that we are, at least I am, coming to you from the traditional territory of the Okanagan Nation, on their traditional, unceded, and ancestral territory. We thank them and acknowledge their rich history and the opportunity to live, work, and play on their traditional territory. This budget briefing is presented by MNP, and we've got a couple of tax experts from MNP joining us. How this will work over the next hour. We'll provide a bit of an overview from the Chamber perspective. We had representatives of our national partner, the Canadian Chamber, in the lockup, as well as their policy folks analyzing every aspect of the budget. So we'll give you a 30,000 kind of overview from the Chamber perspective. Then I'm going to turn things over to our experts from MNP. Both Brian and Marty have joined us. We'll provide a Q&A. You can use the Q&A function or the chat function for that. But before we get there, I do want to acknowledge those that have joined us, particularly Brian and Marty Clement, and they're joining us online. If you gentlemen, there we go. So we are ready to go. Just want to give you a bit of background. Brian Posthumus is a partner and leader of MNP's taxation services team for the Thompson-Okanagan. At the bottom of your screen, Brian oversees the team of tax specialists who assist private businesses with corporate and personal tax planning, working closely with his clients to understand their objective at all stages of their businesses, from start up to succession. He delivers a tailored solution that helps their clients meet compliance requirements while maximizing wealth. Also joining us, nice shirt too, by the way, Marty. I like your shirt. Marty Clement is a partner, tax specialist, and regional leader of MNP's professional services team based in the Thompson-Okanagan. Marty provides tailored solutions for healthcare professionals and business owners to ensure his clients meet their objective. Marty's experience includes providing tax advice to partnerships, trusts, blind trusts. We might get into that as we go through, deal with that issue, corporations and individuals as well. His services include estate planning, corporate reorganizations, and assisting professionals in buying and selling their practices. Gentlemen, I wanted to thank you. I'm going to do the bit overview, but I don't know, did you want to do a brief introduction? Were you both up late last night analyzing this, or you got a team in Ottawa digging deep?
It's a joint effort, but yeah, both of us had a late night and a long Zoom call together. So excited to share all this information with everyone. But yeah, it's always a big lift to digest the volume of the information so quick and get it ready in a nice summarized form.
Yeah, so just on logistics, those that have joined us, we'll walk through some presentation. We are recording this session and we'll post it on our YouTube channel. We also have some documentation and highlights that MNP has put together, and we will share that. We'll email that to all our attendees today and make it available on our website as well. So thanks to the team at MNP, not only for joining us, but for providing that information. And I will say, at any time, if you want to post a question, we'll get to those at the end, but if you want to post that either in the chat function or the Q&A, that would be great. Hopefully that's all working correctly. If not, you can just email the chamber. And also afterwards, for those attendees here, if you have further questions, I think we do one complimentary advice from MNP. I'm just joking. If you have follow-up questions, just give us a call at the chamber, and we'll certainly can put you, if we can't answer the question, we'll put you in touch with the experts at MNP who have joined us. So with that said and logistics out of the way, I'm going to go back to our slide deck, and I'm going to move through fairly quickly some of the highlights from the chamber perspective. One of the things, and I suspect Marty and Brian might comment on this as we get through, the question leading up to this was, how well would they be paying for the things that they announced pre-budget? And we do live in a different world. At one time, just so you're aware, a minister could lose their cabinet position if they actually leaked anything early from a federal budget. Totally different approach this time around from the federal government. They were announcing a lot in advance. So the big question, would there be any surprises? And I will leave that to our experts to answer that question. The other big one was, how would they be paying for these announcements and expenditures, particularly around the military spending, around trying to address affordable housing. So the new measures add up to about $57 billion over the projected period. They have, and I'm sure our experts will get into a little bit of where does the money come from. There has been some changes on capital gains that you need to be made aware of. Raising the inclusion rate is expected to add about 19 billion over the projection. Interesting to note, many of you are probably aware of this, inflation is hurting consumers. Everyone's a little concerned of how that inflation will hit. It's impacting the government, the federal government in the polls. But obviously, it continues to provide some fiscal room because it's also bringing in new revenue for the government with that inflated, that helps offset that new spending. And as you're aware, the remainder of that will fall to the bottom line and will be covered by taxpayers. It's part of our tab in the longer term through deficits and debts that we'll talk a little bit more. The deficit expected to be cumulative, sorry, 10 billion higher over the projection. A couple of other key takeaways from the chamber and the Canadian Chamber perspective. Inflation is the highest in a generation. The central banks have been aggressive, raising those interest and holding the interest rates as restraint has demanded. It is slowing, though, and slowly getting back to target, but not quite yet there. The global economy has not gone into recession, and that's a good thing for all of us. Interestingly enough, the U.S. economy, and you may hear different things because it's the politically charged environment in the U.S., the U.S. economy is actually defying expectations in its growth and performance. Canada's economy has displayed resilience, but fundamentally fragile with a strong population growth, and that's impacting the GDP to per capita ratio, which is important to note when it comes to our longer term debt. Some other key takeaways from the Canadian Chamber perspective, slower inflation, though overshooting prices does mean affordability, and we're hearing it from business community and individuals. Affordability is a preoccupation of many. And this is impacting the younger Canadians even more so. We're seeing this on a provincial basis. There's a leakage of young entrepreneurs to Alberta because the cost of living is a little bit less. So that is of concern to BC as an example. Bankruptcies have started to rise, insolvencies after emergency government programming has ended. That was through the pandemic. So we're seeing an increase in business bankruptcies. And something we continue to monitor from a chamber perspective, a business perspective. Interest rates in Canada are expected to start coming down this summer, but with the strong U.S. economy, rates globally likely going to be higher for the longer period than markets have been expecting. The path for normal GDP, the broadest measure of the government's tax base, is up nearly 40 billion, 1.2% on average over the projection. And I suspect our experts can speak to this much better than I can. The budget also suggests the latest private sector survey reasonably cautious as it's weaker than several other notable organizations. So you have third-party views of where the federal government is, and that comes into play here. Nonetheless, include the downside and upside scenarios as a rough stress test to the books. Canada suffers a shallow recession in the downside scenario. So there are third-party experts that review the financial position of the federal government and share that more widely. One thing we did note, and we try to pay attention to issues that are relevant in BC and to the Kelowna Chamber. We have been a leader nationally, bringing a number of resolutions and policy positions to the Canadian Chamber around tearing down interprovincial trade barriers. Now, it's important to note this is really up to the provincial governments to cooperate and work collectively to remove those barriers. We've had mixed results and even challenges, as many may know in the Okanagan, with respect to Alberta's decision of trying to step in and prevent direct consumer sales of wine from the Okanagan, as an example. The budget, I think page 200 and something, does mention that the federal government is going to launch a Canadian survey on our interprovincial trade in June of this year with businesses to try and identify where those barriers are to give them some leverage in bringing the provincial leaders together to start to eliminate those provincial barriers. So that is a quick summary, as quickly as I could do, and hopefully whet your appetite and some of the more details to come from our two experts. So I'm going to ask Marty and Brian to join us back, and I am going to turn the platform over to, I think, Brian, you're going to start things off, and then going to tag team, and then we'll come back with Q&A. And again, to those that have joined us, if you have a question that arises partway through this, feel free to throw it in, and we'll get to as many questions as we can before the top of the hour. Thanks for joining us, guys.
Thanks, Dan. Thanks for the introduction and the opportunity to speak this to the chamber and the chamber members. Appreciate the opportunity to share this today. Just a couple of housekeeping matters. I guess firstly, an introduction to MNP for those who don't know us. We're one of Canada's largest accountancy and consulting firms with over 125 offices from coast to coast. And here locally in the Thompson-Okanagan region, we have offices in Kelowna, Vernon, and Kamloops with a team of approximately 150 professionals. And within that group, we also have a very strong and robust tax group with 6 tax partners. And we specialize in business, personal, and estate taxation. As well, we have indirect tax, GST, provincial sales tax experts, and as well as international and cross-border taxation. So we boast, pat ourselves on the back, but we do have a very robust tax group for this local area. Of course, a disclaimer, the information we're presenting today is based on information that we are digesting very quickly as we just were reading the budget, of course, yesterday. So this is general information, just intended for education purposes, but it's not intended to be specific advice to any of the viewers here today. Anybody with their own tax problems should get advice from a competent advisor. The big headline, jumping into it, the big headline for this budget from a tax point of view is the capital gains inclusion rate. I think before we delve into it, I think it's first important to explain what the capital gains inclusion rate is and what that means. First of all, in order to have a capital gain, you have to sell capital property. Capital property would be property that's held. It could be shares, bonds, investments, or it could be physical property like a real property or equipment or something used in a business. So you have to have investment property or business property that's sold. That's capital property. And when it's sold, you have to compute the capital gain. So from the sale price, you would deduct the actual purchase price of what you paid for the property, then any disposition costs, realtor, legal fees, etc. And the net result is your capital gain. From the capital gain, then, to determine how much is taxed, you apply the inclusion rate. Now, for the last almost over 2 decades, we have had a 50% inclusion rate, meaning that only 1/2 of the gain is entered into the income of the taxpayer. Whereas in this budget, of course, as we're going to discuss, the inclusion rate will be increased to 2/3. So for corporations, the inclusion rate is going to increase from 1/2 to 2/3, and this is going to be for corporations and trusts. And this new inclusion rate comes into play for dispositions that occur after June 24th. If there's dispositions before that period in the year, then you're actually going to have potentially some gains calculated at the historical inclusion rate of 50%, and then gains after the 24th will be at 2/3. So let's take a look at the corporation and in capital gains and how the taxation is currently up until the 24th. So if you had a $100,000 gain today, the inclusion rate is 50%. So 1/2 or $50,000 is taxable. For a Canadian controlled private corporation selling with a capital gain, its tax rate is going to be 50.67%. So there's corporate tax owing of $25,000 approximately from the sale of that property. And another thing to note is after the corporation distributes the after-tax proceeds as dividends, the end individual is going to pay $29,000 and $29,560 on that $100,000 capital gain. Furthermore, you'll see another calculation here in the slide which shows adjusted aggregate investment income. So the taxable capital gain is part of this what's called AAII, and that's important because if a company has too much of this AAII, that's a hard word to say quickly, but if there's too much of that stuff, then it's going to impact the ability to claim the small business deduction on any active income that the company has in the subsequent tax year. So in this scenario, we've got our 25 grand of tax, 50 grand of AAII, so no grind to the small business deduction, and then overall integrated under the old rules, you'd be left with $29,000 of tax combined, so roughly you're retaining 70 cents on the dollar in the current system. Now, when the inclusion rate is increased to 66.67% or 2/3, now we're going to have to include from the gain 2/3 of the capital gain as a taxable gain. The same tax rate applies, and that's going to lead to combined taxes of $33,780 in the company. Looking at the overall cost of distributing the after-tax corporate gain to an individual, you're going to pay a combined $39,300 on that gain by the time you repay all of it to the individual. So now we're sitting near 60 cents on the dollar retained after tax by the time the gain is paid to the individual. The last box here I've noted is this AAII. As you'll see, it's increased from 50 grand to 66,600. And what that means is we're over the $50,000 threshold. So in this example, potentially in the following year, the company may see more tax on its active income because it's going to have a reduction to its small business deduction of $13,000 in the following year. So overall, more tax up front, more tax to fully distribute, and then of course, potentially more tax on active business income in this scenario if the gain is too high. So the inclusion rate not only affects corporations, it's also going to affect individuals, although there's a few nuances to the calculation. So again, the increase is from 50% to 2/3 for the inclusion rate, but for individuals, the higher inclusion rate is only going to apply to capital gains that are in excess of $250,000. Now, this excess is after taking into account net capital losses and capital gains exemptions that might be applied against the gain. So it's possible your overall gain could be higher, but it's 250 net of those deductions that will be subject to the higher inclusion rate. As well, for persons who have employee stock option benefits from exercising stock options or selling shares of no matter how those, I guess if you have benefits from stock options, the first 250,000 may be eligible for a 50% deduction, but after you exceed 250 in stock option benefits, then the balance will be only get a 1/3 deduction, which kind of makes it on par with the higher inclusion rates. So let's look at some numbers here. So in the current environment, up until June 24th, if you have $1 million capital gain, 50% of it is included into income. So there's $500,000 of a taxable capital gain. And the applicable rate is 53.5% on the highest marginal rate to an individual in BC. And so the personal income tax will be $267,000, leaving you with an effective tax rate of 26.75%. Now, if the gain were realized after June 24th, the capital, and we have a $1 million gain here, the first $250,000 is subject to the 50% inclusion rate. So there's 125,000. The last $750,000 would be subject to the higher inclusion rate of 2/3. So 500,000 would be added to the taxable capital gain. So because of the change to the inclusion rate, we now have 625,000 of income versus 500,000. We apply the tax rate, that's 334,000 of personal tax. So in this case, the effective tax rate goes up from 26.75% to 33.44%. So a jump of almost 6% here. The overall tax paid would be $66,875 higher in this scenario versus if we sold it the previous year, or sorry, prior to June 25th. So how are we going to, I guess as tax planners, we're always strategizing, trying to find value for our clients. And so we have a few discussion points here on how our clientele and taxpayers might be trying to adapt to the higher inclusion rates. So a couple of points here. If a taxpayer claimed a capital gains reserve in 2023, if they had a sale of property and they weren't paid in full and they were deferring some of that tax until payment, they may want to strategize to see what they should do with the remaining reserve. Potentially, they may want to take it all into income in 2024 and make use of the lower inclusion rate versus stretching that reserve onto future years. If a taxpayer has a lot of accrued gains in its property that can easily be flipped or disposed of before June 25th, like an investment portfolio, they may want to consider crystallizing some of those gains to take to take advantage of the lower tax rates that we have for 2 months here. In some cases, we had to assess the impact of what's called alternative minimum tax. This was another tax measure that was released approximately a year ago in the last budget that's created a lot of issues for us in tax planning. So Marty will speak to that more, but it's important to factor that into the equation. If there's a business sale after the inclusion rates changed, I think one would want to really check their numbers and look at an asset sale versus a share sale. Given that the capital gains rates are comparable to eligible dividend rates, we might see some situations where the share sales aren't clearly superior to the asset sales, and sometimes that's easier to do commercially. For personal taxation, after the inclusion rates are changed, because the first $250,000 is subject to the lower 50% inclusion rate, it seems that individuals being taxed on capital gains, that's more favorable than corporate taxation. So if you're a person that might have investments in a holding company and investments personally, you want to look at that overall mix to see where your capital gains are going to land, and if there's a possibility of shifting the mix to having investments that are more likely to get capital gains held personally because of the advantages of that first $250,000 exemption, or not exemption, but rather access to the lower inclusion rate. The higher inclusion rate, as I pointed out, may impact the small business deduction if there's gains in a company because of the grind of that aggregate investment income to the small business deduction. You want to look at using your capital losses very carefully and strategically, and where possible, you want to use up capital losses against gains that are taxed at the higher inclusion rate. I think one would also want to look at their portfolio carefully if they have non-registered investments, and to take advantage of the first $250,000 being eligible for tax at that 50% inclusion rate. You may want to look at rebalancing and triggering some gains from year to year rather than letting them accumulate and having a whopper of a gain in 1 year and paying higher taxes on it. Might be better to pay as you go, so to speak. And then finally, this is a very paramount to business owners and persons with doing estate planning, is that you might have, when you pass away, if you own a lot of capital property that has accrued gains, could be real estate or private company shares or the like, you could have a far significant increase to your tax on death. This new inclusion rate could increase your anticipated taxes by 30% over what you previously estimated because of the higher inclusion rate. So that's a big mouthful. That's a lot of material there. But certainly you can see that it would cause a good look at how your situation might be impacted by the higher inclusion rate. I'll jump into now some other business tax measures that were released in the budget. There's a proposed accelerated capital cost allowance for rental projects. And typically residential rental property, you would only be able to get a 4% capital cost allowance on the cost of the rental property. That's 4% of the building cost, excluding the land. They're proposing that the depreciation rate could be increased to 10%. This would be for construction that begins on or after the budget date and is commenced before 2031. The property has to be available use before 2036. And to be eligible for this special depreciation rate, it has to be rental property, and you have to have 4 or more units being constructed. So just a little bit of something to point out, though, is that there's currently a limitation on creating a loss from claiming capital cost allowance on a rental property. So one would want to explore this legislation further before you jump in and make a decision based on this accelerated CCA, and determine whether or not in fact that you could create a loss from this to provide tax shelter as an incentive to jumping into a rental property construction. So there's also some CCA changes to certain classes, such as class 44, which is patents, and 46 and 50, which is computer related, technology related acquisitions. These categories are going to be allowed to eligible for immediate expensing, and so very immediate write-off basically on the acquisition of property, this kind of property or these asset classes. There's a window for these class acquisitions. You had to acquire them and have them available use before the end of 2026. So there's like a 32.5-month window there to make use of those immediate expensing. There's also a proposal in the budget for the Canada Carbon rebate for small business. This is, I guess, like a rebate related to the carbon tax that's being assessed federally on the various provinces. So this is only for Canadian-controlled private corporations, and the rebate appears to be based on the number of employees, but you have to have under 500 employees to be eligible. The rebate is The rate of the rebate has not been announced yet to the budget, and there is some question as to whether BC-based companies will be able to participate in this rebate, as BC collects and administers its own carbon tax provincially. So we're not clear at this point whether this rebate would be available to all businesses here in BC. There's a clean electricity investment tax credit for Canadian corporations that has been announced. And this is a refundable credit of 15% of the cost of acquiring clean energy electricity generating equipment. So things like solar panels, for example, might be eligible for that. I would point out that this credit is only for Canadian corporations and not for individuals, and it has to be for business purposes. So it's not a credit you would get if you're electrifying using solar panels in your residence, for example. There's if you're constructing a building and you're in the business, which is in the electric vehicle supply chain investment tax credit, there can be a 10% tax credit on the cost of constructing those buildings. And for property, there's limitations on when you have to have that in place. Some of these measures are not all that typical, so whether taxpayers in our local area can make use of these is a bit of a question. A couple of indirect tax measures. Back in the fall, there was an announcement of a GST rebate for constructing rental stock. This GST rebate has been extended to include student residences built by public universities, colleges, and school authorities. And this is for projects that have been commenced on or after September 14th and before 2031, and then completed before 2036. And there's some increases coming for tobacco and vaping. So excise taxes will increase on those two products. And with that, I will pass the baton here to Marty.
Thanks very much, Brian. I'll just share my screen here, so just bear with me for a second while I switch this over. And then maybe Dan or Brian, just let me know if that's switched over on your end, and then I can get going. I should say personal tax measures. How's that? Good?
Yeah, and thanks, Brian. We'll come back to some of that capital gain stuff as well. But Marty, thanks for joining us. All looks good.
All right. Well, thanks again for having us. And I just thought that leading up to the budget, Dan, just like you had mentioned, with all of the spending announcements, there was a fair amount of nervousness, related to possible tax changes. People were wondering, how is this going to get paid for? And there was a lot of speculation, and people were speculating, are they going to change the highest marginal tax rates? Are they going to introduce a wealth tax like they did in France? Tax on excess profits is out there quite a bit, and I just want to make it clear that none of these possibilities that people were speculating on really materialized. But in terms of personal tax measures, I would suggest that the most notable change to the personal income tax changes is really in respect to the capital gains inclusion rate that Brian had sort of covered off. So I'll talk a little bit about AMT and some changes there that create some taxes for individuals, and then we'll talk about some possible opportunities, followed by some odds and sods. Okay, so for the alternate minimum tax, this is kind of going back to budget 2023. And so in budget 2023, it was announced that this AMT calculation, which is always happening in the background of your tax return, they changed some inputs into the calculation. And they changed the inputs into the calculation so that the AMT calculation would usually prevail over your ordinary tax liability. Because as a taxpayer, there's this parallel calculation that's being run, and that's the minimum tax one, and you always pay the more tax, and it's the more of the AMT or the more of the ordinary tax. So going back to budget 2023, amendments were made to the AMT so that the AMT would usually prevail and result in more taxes, and these changes were sort of targeted towards wealthier individuals or trusts. So again, that was back to 2023, and so the draft legislation was published in the summer. And when it went out for consultation, and then we had the notice of Ways and Means motion that was released in November, and AMT was held back, or it was not necessarily in there. So perhaps one of the reasons why we didn't see the changes was that because in budget 2024, there's several technical amendments to the changes they made a year ago. So there's amendments to the amendments. And one of the other things that was really important was that under the original proposals, the donation tax credits, they were limited under the AMT original proposals. And it was creating a lot of angst and concern amongst charities because individuals were sort of dissuaded from donating marketable securities or whatnot to these charities. So one of the things that's happened in the AMT rules this year is that they've seemingly provided some relief maybe in there, but I would still sort of encourage people to calculate that out definitely. So anyway, so that was kind of helpful, I think there. So interestingly enough, even going back to the budget last year in 2023, the government was sort of saying, hey, with these new AMT changes, we think over the next 5 years, we're going to raise $3 billion worth of taxes. Because again, this AMT calculation was configured to prevail over the ordinary tax calculation. And so when we look at the budget forecast for 2024, AMT is now sort of projected to raise $662 million of taxes over the next 5 years. And you sort of say to yourself, well, that's a pretty big delta. What happened there? And I think what's happened is with the capital gains inclusion rate going up to 66%, now the ordinary calculation is going to prevail in a lot of cases over the AMT. So the government's going to catch that taxes in the ordinary tax as opposed to AMT. And I think for the government, as far as the government's concerned, ordinary taxes are taxes paid. AMT is in fact refundable. So a couple of other changes that are just up on the screen there in terms of some modifications to the rules. So potentially helpful here, we're just kind of moving into what might be helpful here, is that there was changes to the lifetime capital gains exemption. And so this is helpful if an individual sells qualified small business corporation shares and or qualified farm or fishing property, and you in fact realize a capital gain. Okay, so this is helpful for when you dispose of your business and you sell shares. So what the budget is proposed to do is they said, look, the amount that you're eligible for in terms of this exemption, starting on June 25th and dispositions thereafter, you're going to have a limit of $1,250,000. So that'll be for the rest of 2024. You'll have the same limit in 2025. And then into 2026, that limit will be indexed for inflation. Okay, dispositions before June 25th, 2024, you'll still have your exemption limit of $1,016,000. So in BC here, if you're able to exempt a capital gain, at the 50% inclusion rate, I should have did the calculation at 66%, but I did it at 50%. But there was about $63,000 of tax savings there. So again, helpful, but something that's, you need to be able to plan for that and be sort of proactive with obtaining that tax benefit. So just moving on, this is a new measure, okay, and there's no legislation that was introduced in the budget yesterday, so a lot of commentary on it. And so what's happened here is there's this introduction of the Canadian Entrepreneurs Incentive, and it's meant to incentivize entrepreneurs to seed and capitalize businesses and to sort of invest in small business, so that's good. So what they're trying to do here is they're trying to say, look, we're trying to reduce the tax rate on capital gains on the disposition of qualifying shares of a corporation, okay, by an eligible individual. Okay, so the first thing we need to take away here is this relates to an eligible individual. If you have a company, you have a trust, I don't think these rules are not probably going to apply to you, but again, the details need to be ironed out here, okay? So, and the incentive here provides for the capital gain inclusion rate, whatever the prevailing rate is at the time, and it's going to be 66% probably next year in 2025, that you pay tax at half of that. Okay, so this is going to start to apply on sales of shares starting January 1st, 2025. Okay, and so what the government said is you're going to get this nice rate on capital gains of up to $2 million. But the $2 million is only accessed over 10 years, okay? So there's $200,000 gain increments that start happening in 2025 and go out to 2034, okay? So this does stack up on top of the lifetime capital gains exemption. This does potentially produce an opportunity to save taxes into the future. The further into the future, the more taxes that you could potentially save. And so, you look at this and you go, this is good. But a couple of comments that I thought were, let's stay tuned and sort of make sure we understand how this in fact rolls out. So on one hand, there's similarities with this new rule compared to the lifetime capital gains exemption. So we kind of welcome that because that's helpful. But they've introduced this concept of a founding investor. Okay, so a founding investor, according to the government, is a person that capitalizes the company, okay, sort of at the onset. So remember, we sort of said this relates to an individual, not companies, but there's also this new thing that says, well, you need to be a founding investor. So what if you bought shares off of somebody and turned the company around? Are you going to be eligible? Maybe, maybe not. I don't know if that's going to be a founding investor. It doesn't seem like it from my first read of this. So that's going to be an interesting concept to sort of see how that develops. The government has said if you're a professional corporation or a company, okay, whose principal assets is the reputation or skill of an employee or of your employees, this is not going to apply. So if you're a service-based business or a professional, you're out. Okay. And the other piece here is a bit of a laundry list. And so there's a whole bunch of other businesses that are operating where this won't apply to either. And so the interesting thing here is that if you're operating a business in the financial sector, the insurance sector, the real estate, food, accommodation, arts, recreation, the entertainment sector, or providing personal care services, this is maybe another scope limitation that it may not apply to you. Sorry, that was somewhat lost my breath saying all that. But anyways, we need to understand exactly what that's going to mean. And so as there's more information on that, it'd be interesting to sort of see how this opportunity in fact avails itself. So an interesting concept. We'll sort of see how it plays out. So moving ahead here, just another concept that was introduced in the budget last year was the concept of an employee ownership trust. Okay. And so as a reminder, an employee ownership trust, okay, is a form of employee ownership where you have this trust, and the trust holds shares of a corporation for the benefit of the corporation's employees. And I think it was sort of predicted that, this employee ownership trust could acquire a business from an owner that would like to transition the business to his or her employees, and the future earnings of the business would in fact be able to be used to sort of pay the vending shareholder. So in the fall economic update, they sort of said, hey, look, if you qualify yourself for this arrangement, you sell your company to one of these employee ownership trusts, under certain conditions, you can exempt $10 million of tax on a capital gain. So you need to have a business that's worth that much, but potentially there are some really large tax savings associated with exempting a $10 million gain. Now, interestingly enough, okay, the government said, look, that $10 million exemption, subject to lots of conditions, and we don't have the time for it today, but subject to the conditions, if you dispose of shares between January 1st, 2024 and December 31st, 2026, that's the time frame where this could be, available. Again, there's lots of conditions here. And so, those would be, there's a bit of a time frame there. And the other thing that's interesting here is when the government forecasts how much some of these measures may cost them, the government has sort of said, look, this particular measure is going to be neutral. So some of the conditions in here are, there's got to be a level of involvement that the business owner has to have. There's a holding period test to holding the shares. The trust that's acquiring the shares, 90% of the employees or beneficiaries have to be resident in Canada. Okay, so there's these conditions that you have to meet for when you dispose of the shares to get the $10 million exemption from tax. And then subsequent to that, the commercial realities here would be interesting to understand more. So subsequent to the disposition, the trust needs to maintain its employee ownership trust status, and there's a couple of asset-based tests on here too. So you can't find yourself being disqualified, because after the fact, if there's a disqualification, the tax incentive effectively gets clawed back. So Again, this would be an interesting one to see how this one develops as well. So just moving on to some of the, or maybe some of the ones that are more related to housing and accessibility. And this was announced pre-budget too. So the home buyers plan is $60,000 you can withdraw from your RRSP now, up from $35,000. So welcome news for first-time home buyers. For taxpayers who withdrew from their home buyers plan between January the 1st, 2022 and December 31st, 2025, so future withdrawals here, the repayment grace period, they're proposing to extend that for another 3 years, meaning that first-time home buyers will have up to 5 years to start repaying this RRSP. So lots of housing incentives are generally available. A couple of quick points here, the Canada Child Benefit. There's a slight modification there. If you're in the unfortunate situation where you have a child that passes away, the benefit will run for 6 months post-passing versus 1. The government was finding itself in situations where it was paying past 1 because of administrative reasons, and then having to claw it back. So that's getting tidied up with this. The disability supports deduction, it allows basically individuals that may have an impairment in physical or mental functions to deduct certain expenses from business or employment income. So they're expanding expenses there that could be helpful. Stay tuned if you're a tradesperson and you're looking for a bit of a deduction. There might be a retroactive deduction that's forthcoming. The government has sort of said, look, we recognize these changes in this private members bill, and we're going to make some changes to kind of clean that up. There's a tax credit for volunteer firefighters. If you complete at least 200 hours of eligible volunteer services in a year, the credit's up from $3,000 to $6,000. And the mineral exploration tax credits were set to expire on March 31st, 2024. They've been extended for another year. So just moving on to a couple of other tax measures. And this one actually, we were sort of talking about this before we jumped on in terms of where we found it. So this one says tax on vacant land to incentive construction. So this is one I think is a stay tuned and definitely keep your eye on, because what the government has sort of said is, look, we're concerned that some landowners in Canada might be sitting on developable vacant land and hoping to profit from rising land prices when the land could immediately or otherwise be used for residential housing. Okay, so sometimes it's referred to a bit of a land bank, okay, or an opportunity to profit. So the government says, we don't want people to profit from not building houses. We need houses to be built. We're going to try and tax that to prevent that kind of behavior. And what we're going to do is we're going to, welcome some consultation and talk to people about how we go about doing this later on in 2024. So vacant land, residentially zoned, is potentially going to be taxed. So again, stay tuned on that one. It'll be interesting to see how that plays out. If you're a charity, just a couple of points here. If you're a board member, you're volunteering, you're involved with a charity, I'd encourage you to go into the budget. They've simplified some administration. There's some information on how to issue receipts electronically. There's details that no longer have to be on the receipt. I'm not going to go through those carefully today, but go and check that out. It should just ease the admin. The government sort of said, look, foreign charities can maintain their qualified donee status for an extra 12 months from 24 to 36. In turn, the government is also asking these foreign charities to file information returns and tell the Canadian government about Canadians that are donating to these charities. So just kind of coming down the home stretch here in terms of the tax administration, budget 2024 really continued a trend of expanding the audit enforcement powers of the CRA. And we've seen this for a number of years now, right? So I think, psychologically, when taxes are 53.5%, tax rates can only maybe not go much higher. But what the government can do, the government can invest in human resources to enforce taxes, and the government can spend, and they certainly have done that. There's been lots invested there. And then they can also amend the legislation to sort of give the CRA more power, right? So in previous budgets recently, we've seen information about mandatory disclosure rules, notifiable transactions, new information that the CRA was wanting in terms of the trust reporting rules, which was on again and off again, true story, for 7 years. Okay, then it was game on for 2023, and 2 hours before the last business day to file all these new trusts, the government said, hey, look, you know what, we're going to pull back on that one. So they suspended that, but again, that's something that's going to show up again probably in 2024. It was not in the budget. So lots there. And just in the interest of time here, I think, there's this new concept of a notice of non-compliance. And so the CRA was sort of catching itself in situations where taxpayers were not coming forth with information in the context of an audit. And the big delay was allowing tax returns to go statute barred. So look, there is legislative changes now that give the CRA tools more access to get information from you, so that the CRA is not put in a position where they can't assess tax returns. So I would sort of say with this, tactically, there's probably now more of an advantage for the CRA. They can collect information and do their job, I guess. Tax debts came up as well too. So there was some tax planning that people were undertaking if they had tax debt. So if you can imagine, if you had a whole bunch of tax debt, or you knew you were going to realize a lot of tax debt, and you had a house that was maybe worth $2 million, you could potentially, under this old planning, you could potentially find somebody, sell your house to them and say, hey, look, instead of giving me $2 million, why don't you transfer $1.7 million to my brother or my spouse? And then you could turn around and say to the CRA, hey, look, I do have this tax debt now. I sold my asset to this arm's length party, and I don't have any money, but somebody in your family kind of has the money. So that kind of planning is going to be penalized heavily going forward, and it's no longer going to be available. And so I think just in terms of our closing remarks here before we get to some questions is that the changes to the capital gains inclusion rates are fairly significant. The one thing that I think is potentially helpful here is that we're looking towards the end of June for when the inclusion rate changes. And previous budgets historically, that doesn't necessarily been the case where you didn't have the runway. So certainly consider your own affairs and how that may work. The Employment Ownership Trust and the Canadian Entrepreneurs Incentive, it'd be interesting to sort of see the application in practice in terms of those sort of headlines kind of thing. More powers to the CRA is always concerning. In the budget at the very end of at the end of it, there are 2.5 pages listed of measures and proposals that the government is working on. For small businesses, that creates a lot of uncertainty. That's a lot of information that is going to be changing, that is changing. And ultimately that creates complexity. And then now that if there are tax benefits and things that you want to arrive at, it's almost necessary to take on some level of complexity. I sort of made mention that the Bear Trust reporting requirements that were suspended at the end of March, after many people had complied with that, there was no information in the budget about that right now. So continue to stay tuned for that. And you know what, if anyone's interested, you can sort of subscribe for these updates at MNP.ca. We do have tax alerts. And I think, Dan, you've got our contact information as well, and our contact information is up here. And I think that's a very particular link to the tax and budget updates too. So I just want to thank everyone again for having us here today, and we can get into some questions, I think.
Well, that'd be great. Thanks, Marty. And Brian, I'm assuming will join us on the camera here. So we can go off share screen. We'll bring you all total in. And those that have joined us, if you have some questions, use the Q&A. I've also activated the chat. You can use the chat to get to us directly. It's interesting you talked about the capital gains. And I don't know if you can make a comment, because one of the things that the Canadian Chamber, and certainly from a business perspective, if the government takes more money out, it doesn't get reinvested. And we want to help strengthen the economy. So part of that is giving the money back, not taking it in the first place. Do you have a sense of how that might impact, or is it a kind of wait and see if that increase in the capital gains now is going to government? It's not available for other investments. Is that potentially, or is impacting the economy, or will it be a wait and see if we don't have that money available for reinvestments?
I think it's always a question, Dan, of how will investors react to as far as an increased tax on capital gains, particularly for persons for outside of Canada investments. And so I think that's the draw of capital And I think maybe does it change entrepreneurship and people's attitudes towards starting their own business? That's debatable, I guess. Some people might be just entrepreneurial anyway because they want to run their own business. But I certainly think it's a shot in the arm to entrepreneurs and people who are taking the risks and using their capital and creating businesses, buying equipment, putting in leaseholds and whatnot to operate stores. So in restaurants, like it's a big it's a disincentive, I guess, to those I think who are taking the risks. So which I personally I don't like to see that. So so
Yeah,
yeah, sorry,
sorry,
Martin, go ahead.
just quickly, I think like, we're heading into a knowledge-based economy. We're investing in artificial intelligence, green technology, all of these things that are unproven that we're trying to be leaders in, right? Like there's an element of risk in that, right? There's trial and error, like let's see what happens. So I just think to Brian's comment there in terms of taking the risk, right? Because some of these things are going to fail a few times before they work out. That when you're paying more tax for when you win, it probably shows up into your risk profile when you're thinking about making the investment, and whether or not you deploy it or not.
Right.
Yeah, and given the mobility and the knowledge-based economies and the fact that somebody with a big brain and not a big business can take that big brain to other jurisdictions and create wealth there, it's and they're probably attractive to other jurisdictions as under immigration status, et cetera. So I think it's a bit of a relapse, I think, back to the 1990s, sort of when I was growing up. You always heard of people heading out of Canada, going to the United States or other countries because of the opportunities that seem to lie outside of there. So, and that could go with professionals, doctors, et cetera, too. So, I think there has to be some realization of the brain drain impact too of higher tax rates as well.
Yeah, we did a question. It's an interesting one that might prompt some other questions along the way, and whether you can comment or not, or you've had enough time. And I'm conscious you just have been through this process. Yesterday it was tabled. Much more going to unfold probably as we get into the weeds, so to speak, in the next couple of weeks. Is there an East-West Canada split noticeable in the budget? Has Western Canada been fully recognized as a full partner in this budget and the spending measures? And I don't know if you can make the comment too, because some of what we see is a response by the federal government to issues that are very metro or urban and not necessarily rural. Did any of that pop up when you were looking at the analysis, either a regional split or catering to more eastern issues versus west, or more urban as opposed to rural? And I mean, if you can make a comment on that, or if you saw any of that or heard any of that. It's an interesting question.
It seemed like a bit of a shotgun to me. There was stuff there for farming, there was stuff for clean tech, there's stuff for building homes and mining. It seems like a lot of spaghetti thrown against the wall to see what might stick. And as you said, I think in the intro, it does seem very sort of politicized and sort of vote shopping. That's what I'm seeing. But
so maybe as an example of the regional, and it's just because in BC we've got a carbon pricing system provincially. There is now a business rebate federally. Now the question would pose for a business in BC and potentially a business that operates across provinces under 500. Can they? I'm assuming the federal government's not going to rebate anybody that's not paying, so that then excludes BC. But what BC has for a rebate, does it potentially create more challenges for business in BC because they're not getting the same rebate as their counterparts across the border in Alberta? Did you guys do any of that analysis or any comments on that? Or are you going to leave that? Maybe we'll do that.
I guess, yeah, I don't see, there is a question of equity there for sure, because we have our own carbon pricing, and if we're not able to participate in the federal one, what does the province do to put us on equal footings with other with other businesses across Canada, because we certainly we're bearing the cost of carbon tax for sure, and why 8 of the other provinces get it, or however many there are, and we don't, but yet we're still paying it. So I guess that's probably a question to take up with the provincial government and to bring to their attention. And they just tabled their budget not long ago, and it was before this, so I don't know what their reaction will be. So
Yeah, and some we'll explore for
they
our
seem to have
members.
some, yeah, they were running a deficit too, so I don't know what's left in in their coffers there. So
yeah, we'll check and do it, and theoretically you could have make whole provisions so that's not too much disincentive or return. But we'll follow up. A couple questions, and then we're getting close to the top of the hour here, or right on it. This government's last full year, this is an interesting one, budget prior to election 2025. Would you consider this an election year budget, or are the goodies waiting to be announced in 2025 pre-election? And it's an interesting one because it speaks to the financial position, and because of inflationary rates, the government coffers are a little top up more than they expected. They're down in the polls, but the revenue flows. So is there room in this budget for additional spending, in your opinion? Have you been able to look at the big picture stuff there? Or would this be construed as a pre-budget, given we're into a federal budget in 2025? Good question. You guys want to venture there?
Yeah, I don't think I can really comment on that one, I guess.
Yeah.
It almost seemed like it was a pre-election budget. I don't know. Look, the reality is there's a lot of spending, right? A lot of programs. It was certainly configured for the middle class. It was configured for younger Canadians, right? Those are all things that were in there, right? And there's a lot of programs and policies that are going to be invested in by the government to support a lot of that.
Yeah. One housekeeping one on the digital side, interestingly enough, the Canada Digital Adoption Program, CDAP, and I think you guys were involved in that. It from our end, it looks like it's not there anymore. So is that coming out? Although there's focus on cybersecurity. Did you see that anywhere in there? That CDAP funding is coming to a close?
I didn't see anything that was sort of reviving the CDAP funding. I know the CDAP funding had closed, but going through the budget, I didn't see any new spending, I guess, for that particular program.
Yeah, it's interesting from our perspective. We look at what's in, but also what's not in, or at least what's not readily indicated. The funding for housing, the funding for the military was talked about that. Not a whole lot for transportation infrastructure, interestingly enough. So we'll look at that. There is another question here. Will the increases to the home buyers plan to increase the borrowing limit and longer repayment period make significant improvements for Gen X, the millennials, that are targeted through this budget? So it's an attempt, but I guess it's wait and see whether it makes a difference, right?
Well, I think it's wait and see. Now, the one, so you look at it and you say, look, it went from 35 to 60. That's great. Now, look, if you've got a spouse or a common law partner and you can save, maybe it's 120,000, right? That both of you can use. So if you start coupling it together, it's 120,000 versus what was 70. So I mean, it would certainly help, but again, you have to be able to save the money to be able to pay for the house, right?
There's also the first home buyers plan too, which was announced. So I guess when you add all those things together, I think that can amount to like $100,000 potentially of like pre-tax money that you could use per person towards a home purchase. As Marty said, though, it's all subject to the disciplines and being able to save that in the income levels, which not everybody has enough disposable income, of course, to or they might have pensions and things too, but disposable income to come up with the money in the first place, even be it that it's tax sheltered, is a question for sure.
Yeah, so 60,000 under the home buyers plan, and then 40,000 under the other program, right? That's the 100, right? And so I think the same thing would work. Maybe it's 200 if you've got two people doing it, right?
Yeah. So it's whether it can that also puts upward pressure on the housing prices, because I know the province released property transfer tax exemptions and increased those on first-time home buyers as well. So it's kind of a function of the market, I guess, whether if you have more buyers with more money, that tends to put those starter homes into higher price points too. So
Yeah, I guess on the housing file, I did want to note and actually give some credit to MNP. They did some study with Canadian Home Builders Association a number of years ago to quantify how much government at all levels are at the trough in housing and how much they extract. So this is on the input side of housing. The federal government, the local governments, the provincial government, they're all extracting a lot of money. And I haven't seen a whole lot of effort from out of them to back off on that. Instead, it's the kind of tax and spend. We'll take it and then we'll give some of it back, and only to those that we. So our line, if we want to get serious on housing, we have to look at the input costs. And some of that, whether it's development cost charges, amenity at the local level, or the taxation that is accrued, there's a lot of information out there that we've got to focus on that if we really want to get serious on that. So, and MNP did some great work on that study, and maybe we'll see if we can recruit you to do it again. So that there's transparency and who's at the trough, so to speak, on the housing side. Hey, it's been great, Marty, Clement, and Brian Posthumus has joined us from MNP. Final plug, if people want to get information, can they just go on the website or get the newsletter through you guys? We will send some communication out, but that's the best way.
Yeah, absolutely, that works. Yeah, we're on mnp.ca, and then yeah, and there's the tax alerts. There's, you know, our direct contact information is there too. And Dan, if anyone contacts you because they can't find us,
we'll make it happen.
You know where to find us. Yeah,
you betcha. Yeah, and we'll share with those who have joined us. Thanks everybody for tuning in. It's been great to have you here. I've often said, if you want to know what the priorities are for any organization, look at its budget. They may have values and principles, but look at where it spends its money. That tells you a lot, and it's great to have the expertise that we have in our own backyard with the folks at MNP. So thanks both Brian and Marty for joining us. It's been a pleasure. So we're going to wrap things up.